So we are going to discuss about the models for measuring financing risk. Okay. Actually, there are two types of models. One is the qualitative model for measuring financing risk, and another one is the quantitative type models for measuring financing risk. So between the two, qualitative and quantitative models, let us first discuss about the qualitative models of measuring financing risk. You understand that for managing financing risk, at first you have to measure it. How much, what is the degree of financing risk associated with a particular funding customer. Let's say we have three funding customers: customer A, customer B, and customer C. So which customer should be rejected from the funding arrangement? Which customer should be set a stricter terms of funding? Which customer should be more monitored? Okay, so these kind of decision actually depend on the degree of financing risk associated with each and every customer. So the degree of financing risk can be understood by measuring those, okay, measuring the financing risk. So how can we measure that? We can measure the financing risk using two approaches. One is quantitative and another one is qualitative. So qualitative models are appropriate for the customers for whom we do not have access to the public information. You know that the business organizations that are publicly listed, that are the stocks of which business organization are traded in the share market or capital market, we know their income statement, their balance sheet, all these things, the financial information is publicly available. But the information about a private limited company or sole proprietorship business or a small business which is not which has not gone public, their information is not publicly available. So even if we want to use quantitative model, that will be very difficult, because quantitative model actually needs quantitative data, from the financial statements. So very often we need to depend on different types of qualitative models. And this is reality. That not every customer is public limited company. In your branch of Islamic Bank, you might not get every customer, who are publicly listed company. Rather, I think most of the customers, they are not public limited company, and their financial statement information is not publicly available. Audited financial statements are not publicly available. So it is a bit challenging to apply the quantitative models. In that case, it will be useful to utilize a qualitative model where a great degree of subjective judgment will be used. Okay, so we understand that in qualitative models, we will have to use subjective judgment in many cases. So even if we want to use the subjective judgment, we need information. We may not get the publicly available audited financial statement, but we still need certain type of information, and that can be available from different private sources. So where can we get the information necessary for the qualitative models? As I have said, it can be the private sources. So what are the different private sources? One can be the credit file or deposit file, because the same customer may have taken funding in the past years, or the customer might have maintained a deposit account with the Islamic Bank. So if this is the case, that file can give some kind of insight, and also and also many information and also necessary information about the customer. The transaction information, all these things are very important in that case. The second one is the is purchasing information. There are many parties, at least in the developed country, they sell information about different business organizations. They collect the information, they store it, they maintain it, and they sell the information about the private companies. It is their business. So I don't know whether it is available in Bangladesh or not, but information can be purchased from different parties who provide information about the private organizations. And another one is Credit Information Bureau. I think all of you are quite familiar with this. The commercial banks, be it conventional or Islamic, they can access the information from CIB or Credit Information Bureau. Okay, from the Credit Information Bureau, it is possible to get the information. And Credit Information Bureau is established in Bangladesh by the Central Bank, Bangladesh Bank. So you can get the information about the customer. And it is very organized and very useful. Okay, you can get the information from the CIB about the customer. So subjective judgment about the probability of default based on actually the subjective judgment about the probability of default can be developed based on key factors with appropriate weight. For example, you get a number of number of observation from the credit file or deposit file of the customer. You get the considerable amount of information from purchase data. You also get the information about the customer from CIB, and also the file that has been submitted by the customer. So information about different factors, okay, will be subjectively judged by the management of the Islamic Bank to come up with the probability of default. And definitely, all factors are not equally important. So the manager or the decision maker will have to know which factors are more important and which factors are less important. And based on that, the weights will be should be given to different factors. And based on all these things, that means providing appropriate weight to the relevant factors and making subjective judgment about all those factors, the Islamic Bank should assess the customer about its probability of default. Of course, subjective judgment is such that one manager might come up with a different probability of default from the other manager. So different decision maker might come up with different decision. That is true, but that is the limitation. We cannot do anything about that. That is the limitation of qualitative model. But still, because we cannot apply the quantitative model, objective model, so we have to depend on qualitative model for many of the funding customers to measure the probability of default. That means the probability. That means the financing risk associated with the particular customer. So now let us talk about a little more detail about the factors. Let's talk a little more detail about the factors that should be carefully analyzed about the funding customer. The factors can be divided into two parts. One is the borrower specific factors. That means the factors that are related to the potential customer, the funding customer, the size of the business, the history of the business organization, many other factors. We'll talk about that in detail. And another one is the market or economy specific factors. You understand that after getting the funding from the Islamic Bank, the borrower or the funding customer will invest the fund. And providing the cash flow to the Islamic Bank will depend on the success of the investment. And you understand that the success of the investment depends on many things, and among that, very important one is the upcoming economic condition or market condition. And interestingly, different business organizations are affected in different manners by the changing market or changing economy. Some industries perform better in case of an economic recession, but there are some industries, maybe they are few, but they perform. Okay, sorry, I have given a wrong example actually. Okay, many industries perform better in a good economic condition, but there are a few industries which even perform better in the recessionary economic condition. Some industries are not much affected by the business cycle of the economy. That means whether the economy is booming or the economy is recessed, that does not affect much. For example, the food industry, people will have to eat, so necessary foods, the necessity goods, that industry is not much affected by the business cycle of the economy. But the industry related to luxury goods, automobile, these kind of things, they are largely affected by the changing condition of the economy or the market. So in which industry your borrower belongs to, that is also very important. And how, what is the possibility of upcoming economic trend or market trend, and how that upcoming market trend or economic trend is going to affect the customer, your customer, that particular industry, where your customer belongs to, is very important to consider. So considering only the borrower specific factor should not be sufficient in making a funding decision. It should also be complemented by the consideration of the upcoming economic or market specific factors. So now let us give some examples of borrower specific factors. Reputation, that means the lending and borrowing history. We are becoming more specific in our discussion. So one example of reputation is lending or borrowing history, which you can get from probably from the purchase information, or from the CIB report, or from the suppliers of the customer, the funding customer. You can get all those information. That is an example of how you understand the reputation of the customer who wants to get fund from your Islamic bank. Then the second borrower specific important factor is volatility. So by volatility, we mean the variability of the business situation or earnings or cash flow. How variable it is, For some business organization, it is quite steady. It remains quite fixed. It does not change much. But for other business organizations, it may fluctuate too much. So if the earning or cash flow of the customer, of the potential funding customer, fluctuates too much, then you also are going to your Islamic bank is also going to face a high degree of uncertainty whether the business organization will be able to pay all the dues in future. So volatility is also another important borrower specific factor. Next one is the collateral. As I have mentioned before, the asset that is being used as collateral should have value, should have realizable value, should have a marketability. It should be possible to market. That means it should be possible to sell in the market. Only having value is not sufficient. Whether the Islamic bank can realize the value from selling the collateral asset or not. That is also another important factor. The leverage of the funding customer. So what do we mean by leverage? By leverage, we mean how much existing borrowing has been taken by the funding customer. That means the existing financial obligation. What is the already, what is the financial obligation the customer is having right now? If the customer has already taken fund from other Islamic bank, in a sufficient amount, and or in other words, if the business organization has very small amount of equity investment from the owners and they are largely depending on funding from the banks, then we can say that it has a high degree of leverage and it has a high financial obligation. So it will be risky to fund that customer, because the customer might not be able to fulfill so huge financial obligation in case of having a lower profit or loss. So this leverage is also another important factor. So you can understand there are basically 4 very important borrower specific factors, but it is not limited to these 4. Of course, you can come up with more borrower specific factors. So what are the 4 important borrower specific factors? Reputation, volatility, collateral, and leverage. Now we will discuss about the market or economic specific factors. The business cycle. It is important to understand the business cycle. By business cycle, we mean that the economy does not proceed in the same steady manner. Rather, sometimes the economy performs better, sometimes the economy performs worse. So that is called business cycle of the economy. So what is going to be the next business cycle? Is the economy going to boom during the upcoming 5-year period for which the borrower is requesting for fund? So if the economy is going to boom, normally how does it affect? How does this business cycle or how does this condition of economy affect your customer? Is the business organization positively affected by the booming economy or negatively affected by the booming economy? You have to analyze that. Okay, so this is about the number 1 market or economy specific factor. I have already mentioned about different types of industry perform better or worse. For example, in case of recession, luxury or durable goods perform worse. So you have to be careful in funding a customer who does business with luxury good, and the upcoming economic cycle is basically recession. Okay, you have to be very careful about that. This is an example. You can explore the business cycle of the country from different sources, of course. We have internet, we have many sources, credible sources of information of the economic trend. So you can, of course, do that. Another important market or economy specific factor is the level of interest rate. You know that the central bank in our country, Bangladesh Bank, it decides about the monetary policy, whether the monetary policy will be restrictive or expansionary. For example, if the central bank is progressing toward a restrictive monetary policy, that means the interest rate should be higher, because there will be a lack of supply of fund or money in the economy. So the interest rate will be higher. So if the interest rate is higher, how is it going to affect our potential funding customer? The fund is going to be scarce in future and expensive for the Islamic bank and other banks as well. Okay, and definitely to fulfill the higher level of interest rate in general in the economy. I'm not saying that the Islamic bank is charging interest, but definitely the market for money is affected by the level of interest rate, and we cannot escape the effect of the interest rate. Okay, so ultimately what happened, if the level of interest rate is high in the in the market, in the fund market, then the debtors, who get the fund either from Islamic bank or conventional bank, they will have to they will have to try for a greater amount of profit and take excessive risk for that. If the interest rate is low, probably they would not have invested in a very risky business. They would have been very choosy about investment. But when they are getting fund, expensive fund, paying high level of interest rate or high funding cost, they will have to, they cannot be that much choosy about the investment. So they will have to take more risk in their business. So what will happen ultimately in the overall market, as a whole, the debtors, the investment, the deficit investors who seek fund from the banks, they will, as a whole, they will become riskier. And we have to think about our customer, how our customer is affected by this. So these are some examples of market or economy specific factors.